Awesome. So as you guys know, the topic for today is dissecting risks in AMMs. So we're gonna first look at how the infrastructure of automated market makers work and how it's evolved. Like not just AMMs, but Texas in general and finance in crypto, has that evolved, just to get everyone up to speed at the beginning. And then we'll dive into the two main players involved in decentralized exchanges, which are the traders and the liquidity providers, and the particular risks that each of them have and how they can mitigate risks accordingly. So before that, quick update about Into the Block. We have a lot of things to share. We just recently launched a partnership with 3 Commas that have you're using our data for their robo-advisor-like product. Then we have a lot of stuff that we've been working on coming soon to Into the Block that we'd like to share a teaser about. We're expanding our risk metrics. So a lot of the ones that I'll be talking about in AMMs we're building for Curve. We're also building similar for Aave's Go stablecoin and the Moonwell lending protocol. We'll also be launching soon optimism metrics. That's actually going to be the next webinar topic, and integrating multi-chain functionality, launching optimism tokens as well as OP, and updating the staking metrics that we have available at Into the Block. Awesome. So without further ado, let's dive into finance and crypto. So I would say that we've seen 3 phases for financial applications and crypto since the very beginning. Since Satoshi's vision, it's been planned to have trustless applications for finance on the internet. That's sort of the core values driving a lot of the blockchain innovation. And first we see it in the shape of Bitcoin as trustless money. But of course, it has limited usability, especially in the early days, a bit more now. And then we see the first forks trying to extend the use cases of Bitcoin to broader applications. Most of those failed, if not all, of the UTXO forks. Then we see more of a general application layer with the advent of Ethereum and later Alto 1s. And this became more of an era of experimentation that has lasted sort of the last 4 or 5 years. As we see the first financial applications come into play, many of them get billions in total value locked, but really in terms of users, limited to the thousands, at most tens of thousands of users. So limited adoption in the grand scale of things, even though we've come a long way. And sort of what we're starting to see now is, in my opinion, the transition between like a phase 2 and 3, where we move into layer 2s and a lot of the infrastructure behind these financial applications get abstracted away in order to simplify things and make it more ready for financial adoption. So with that in mind, one of the key innovators, key catalysts that enabled us to move from like no adoption to some adoption was adapting models to be blockchain native, so that they are essentially suitable for the constraints in terms of like throughput and other things that blockchains have. So before AMMs existed, we have these decentralized exchanges like Ether Delta here that were quite skeuomorphic, meaning they would try to resemble exactly what an exchange was, but on the blockchain. And so you can see here order books. You can see here from the price that the liquidity was terrible. And since it needed to match an order with another, and you would need to pay for gas every time you post an order in the order book, this model like completely failed. And that's with a peer-to-peer layer for regular exchanges. And so as people start realizing those constraints, we transitioned into a peer-to-pool model, where one just posts liquidity into a pool, and then we have a lot of automation carried forth by the smart contracts that enables us to essentially trade and rebalance pools a lot more efficiently than if you would have to submit an order every time and pay gas and wait for block times. So we essentially made the transition probably back in 2017 or early 2018, and it kickstarted the ideas of AMMs. Initially, Vitalik was the one who proposed it on a Reddit post. I don't think he came up with the name itself, but the core concept. And then we see the Bancor ICOs and Kyber ICO as well, raising very large amounts. I'm forgetting the numbers, but I think Bancor was in the hundreds of millions, Kyber in the tens of millions. And we see finally the Ethereum Foundation give Uniswap a grant. And actually, Bancor and Kyber launched AMMs before Uniswap did. But interestingly, as we maybe will talk about later, Uniswap ended up gaining the bulk of the market share despite being a later entrant. And so what is the AMM model? Essentially, being an automated market maker, it's balancing liquidity instead of like in an order book where you have to manually rebalance. Here, it's carried forth through the simplicity of the formula of X times K. I imagine many of you are familiar with this, but just to make sure we're all at the same speed, X is the value of all the assets, asset X. So let's say ETH, and Y is the second value's asset, let's say USDC, and K is the liquidity constant. So essentially, this value remains the same, and the liquidity of these two rebalances in order to stay 50-50 in regards to K relative to the K liquidity constant. So that's how essentially the liquidity of one asset and the other ends up rebalancing to be able to preserve that 50-50 pool distribution share. And this creates like having this simple model, which of course has evolved even further, but starting with this was great because it allowed anyone to create a pool and provide liquidity to a market. So things that in traditional finance world take, I don't know, 5-10 years to be able to set a company, get it audited, everything. Right now, it has its pros and cons, but anyone can create a market in Uniswap or any AMM in a trustless manner and be able to get liquidity there provided by external or internal parties. And of course, this also creates a new set of risks, aside from being able to create any token and scams, but for more serious projects also. So things like prices diverging, what is known as impermanent loss, which leads to, due to the rebalancing mechanisms, owning more of the asset that is decreasing in price. So that was sort of the first iteration that we see in Uniswap v1 and v2. And then we sort of hit a roadblock in terms of adoption because trades were essentially not as efficient as they are in AMMs, as they are in order book exchanges. To this day, they still are slightly less efficient, but there's a lot more, like an order of magnitude more efficient since the introduction of concentrated liquidity. And what this does is essentially, instead of providing liquidity in the whole range of potential prices, which of course goes from like 0 all the way to infinity, liquidity providers can now select to provide liquidity in just a segment of the liquidity. So you can see here in this graph, it's essentially a subset of the previous liquidity that you're providing liquidity to. And this makes it such that that range has a lot more concentrated liquidity and therefore can manage slippage in a much more efficient way. So these numbers we got from a few months after Uniswap v3 went live, so they might be outdated. But right out of the gate, the difference in capital efficiency as measured by volume over liquidity was about 3x. So quite significant. But it also brings the risks for LPs. Then since you are in just a segment of the whole curve, then your variation of assets within the pool is much greater. So essentially you're leveraged within that range. The tighter the range, the more leverage you're taking on, and the more risk you carry of ending up with a significant share of assets that decrease in price. And so that was released back in 2021. And it took some time to surpass Uniswap v2 in terms of liquidity, but in terms of volume, I think within the same month, it already surpassed it. Nowadays, it's also the most liquid in terms of like Uniswap versions. Curve still has more liquidity. But in terms of volume, by and large, Uniswap v3 dominates with 50% market share. I believe it reached something like 60–70%. But then we've also been seeing more UniV3 forks now that their business license has expired. So PancakeSwap, for instance, has their own fork of UniV3 that's been getting some traction, as well as a few other concentrated liquidity models. All right, so we've determined that UniV3 concentrated liquidity model is so far what seems to be the winning model for DEXs, aside from, at least for traders, perhaps not necessarily for LPs, as we'll get into. But what can you do to manage risks that are created by this infrastructure? So as usual, we tend to classify risks in two main categories: technical and economic risks. Technical risks have to do, of course, with smart contract risks from the protocols that you're using and how they can be exploited to extract capital. And economic have to do with slippage, so essentially the cost that you incur for swapping one asset for another, and also MEV, maximal extractable value, which can lead to an implicit slippage that perhaps isn't accounted for. And finally, since all of these protocols are trustless and permissionless, you also have your self-custody. So that brings the risk of self-custodying, which of course can be risky if not managed properly. So in terms of trader risk mitigation, for technical risks, it comes without saying, but do your own research, of course. Don't just ape into any protocol that has high rewards or buy any token that's pumping in price. Make sure to research the protocols that you use to avoid losses or being scammed outright. A good practice is to set up multiple wallets. Excuse me, I'm a bit sick. Set up multiple wallets so that if you give permissions to a protocol, it's only that wallet that's affected and not, let's say, your core vault wallet where you keep most of your savings. Another good practice is to revoke permissions. So if you used a protocol back in 2021 when you were chasing high yields, it's probably best to revoke those permissions, just in case they do anything with those permissions, because once you approve an asset, typically you give the protocol permission to access all of your assets unless specified. And finally, it's worth double checking the links and not just favoriting them, since those can get exploited as well, but checking that you're in the correct URL. In terms of economic risk management, one key feature that's quite simple to use is to adjust your slippage tolerance. So you can set it to whatever you'd like. Ideally, So in protocols like Uniswap, you see the slippage that you're expected to have. And I would recommend putting a slight buffer on top of that, and not too high, because you'll also have some MEV bots that will push it up to your slippage tolerance. So essentially set a low slippage tolerance close to what's expected slippage, and be aware that there are going to be bots trying to what they call sandwich attacks, do sandwich attacks on you, which essentially means increase the price that you're going to buy at and then dump it slightly more right after you buy, which of course leads to a bit of an economic loss. There are some protocols that claim that they've solved MEV. So far, the ones I've seen don't fully solve it. And even if they improve on it, they don't have enough liquidity. So it's probably best still in terms of economic risks to go ahead with a market with better slippage and just be aware of the MEV risks. Okay, and now into the main subject. So liquidity providing can be even riskier and more complex than trading indexes. So that's where we're going to dive a bit further on. So there are many risks to consider. Just as with traders, we can classify them as technical or economic, but they're slightly different. Because here, when you deposit into a protocol, you lose risking everything that you put into the protocol. If the smart contract is hacked or the protocol has access, quote unquote, backdoor access to the funds or upgrades the contract to rug pull and steal those funds, those are some risks that are out there, but worth considering. And from the economic side of things, we have a lot more risks to consider than traders do. So impermanent loss is the main one that people are increasingly aware of. But not just that, you also get entry or exit fees into a pool, especially into the Stableswap model pools. If it's a stable pool as well, you risk depegging events, cutting your losses, or potentially fully owning the asset that depegged and losing all the funds that you put into as well. And pool imbalances from inflows and outflows or whale positions that can essentially completely flip the distribution of the pool and leave you with the losing asset as well. Forgive me just a second, I do have to cough. All right. So back to the good content. In terms of technical risks, goes without saying, but auditors are important. But just because it's been audited doesn't mean that a protocol won't be exploited. At Into the Block, we've taken the time to evaluate the top 100 exploits that have taken place in DeFi, classifying them as if they're economic risk exploits or technical ones, and if they've been audited or not. And by and large, most of the attacks that take place, or at least the largest category, is for unaudited protocols. So it's worth checking the auditor track record. I know this is not fully transparent and there are more factors to consider than just the number of attacks. But here's a good distribution showing some of the main auditors and how many attacks they've suffered. Other than that, it's also worth checking if the protocol has bug bounties set up, if they're rewarding people that identify exploits. Essentially, if they have a multi-sig setup and what exactly is it. So it's not enough just having like a 2 out of 3 multi-sig setup where 2 of the founders can have access to all of the funds. Needless to say, that's not ideal. It's preferable, and this is what larger protocols have been moving to have more people involved in the multisig and not just internal people, but also highly reputable people that can act as secure mechanisms for the protocol in order to validate things like smart contract upgradability that can theoretically access funds. We saw this issue with Oasis. I don't know if exploit, but the removal of assets from the hack of the wormhole exploit. So that's a different tangent to explore another day. And essentially, with this setup, evaluate if it's a ruggable protocol or not. It takes some time to evaluate that. But probably in Discord, if you ask the right questions of if it's a multisig, who's in it, what are the rights that the multisig has, if they have a governance time block before a change is implemented. Those are some key filters to evaluate. Then on economic risks, there are many things to evaluate. I think first you have to consider whether you're in a volatile pair or a stable pair. That's the first thing. And then depending on that, you can essentially look at multiple levels of depth classifying these risks. So if it's a volatile pair, you definitely have to look at the impermanent loss. And for stable pairs, it's not just as simple as depositing and forgetting about those funds. You also have to monitor depegging risks and pool imbalances, which can lead to losses for LPs. For impermanent loss, there really is no successful prevention mechanisms, unfortunately. There are some mitigation mechanisms and there are protocols that have spent years working on this and still no clear solution. So a few things you can do here. First is definitely monitor that and consider the risks prior to depositing. Historically, highly correlated assets such as Bitcoin and ETH that have been trading range bound for a year or more, those tend to be good performing LP pools in terms of low impermanent loss risk, and it's worth considering ideally to exit a pool that you're in if it's a volatile asset at nearly the same price that you entered if you're looking to maximize the total value of both assets. So we do have a impermanent loss risk calculator, and it's interesting for some of the UniV2 forks. Then for Stableswaps, we just saw a month ago how stable coins are not necessarily as stable as we would like them to be. So it's worth being cognizant of this risk and not just taking their stability for granted. So there are depegging events like we saw with USDC, with UST, which was even more tragic, of course, and temporary depegs in liquid staking derivatives like staked ETH that have led to significant losses in the tens or hundreds of millions to LPs that are not managing risk properly. So how do you manage that risk? One of the main factors that we've realized that are like a good alert ahead of time. So of course, you don't want to exit a pool once USDC is at 89 cents. Ideally, you can monitor in advance and take actions prior to losing capital. So here we have an indicator freely available into a block where we track the liquidity distribution within an asset within a pool in Curve. And this is 3 pool, the largest pool for USDC liquidity. And let's dive into what happened the day of the USDC depeg. This is March 10th. SVB was already, seemingly going down. The pool was still highly pegged when the day started, highly balanced. So you can see 33% each of the assets in the pool. And come 4 p.m., the pool went from 33% USDT to just 15% or so. So it was already mostly USDC and USDT and USDC and DAI, since DAI is also, you know, backed by USDC. And at that point, the peg of USDC had just reached 99 cents here, but the pool was already in balance. So you already knew that people were exiting the pool at scale with a lot of USDT, and that exacerbated the further depegging event, which occurred later at 8 p.m., at 10 p.m. or so. And then that just saw within an hour or two, the price of USDC to drop all the way to 89 or 88 cents. So here's a good measure of how you can see the pool distribution directly impacting and anticipating, in fact, these depegging events. And a different side of the same coin is tracking those inflows and outflows into the pool, what asset they're withdrawing, what asset they're entering, and if in general the pool is growing in liquidity or decreasing. So that's why we track the net flows within that. And an even more gigabrain approach to this is anticipating potential outflows. And you can do so by tracking the concentration that the pool has in certain whales. So for instance, if a whale has 17% of the pool, you can forecast and calculate what that can lead in terms of slippage for you to withdraw after them. So that's already like a potential vulnerability based on this infrastructure. And if you're aware of these numbers, you can act in advance. This is actually one of the metrics we're going to be releasing for our curve risk grader metrics. So hopefully soon enough, people will be able to access a lot more risk management for LP data for free. And a few final notes before concluding. A lot of these factors that I mentioned are interconnected. So you can think of them at the asset level, kind of like UST, at the pool level, more like what I showed with 3-pool depegging, or has happened with other pools. At the protocol level, technical hacks that can, you know, take all of the funds within the protocol in the worst case scenario. And I think in conclusion, liquidity providing is not as passive as it seems to be. It definitely takes a lot of monitoring and risk management to be able to mitigate losses, which we've seen time and again. Thanks for joining, guys. To conclude, AMMs provide a lot of new opportunities, but come with their own unique risks. There's a inherent trade-off between the traders and LPs at times that has led to concentrated liquidity model where, you know, traders get less slippage, but LPs are susceptible to more volatility. You can argue that also lead to more LP fees, but certainly also to greater loss potential. From the trader side, if you're just looking to buy a meme coin on Uniswap, make sure to do your own research, of course. Set a slippage tolerance, revoke permissions, have multiple addresses. Be careful. In general, crypto is risky, of course. And with LPs, where you can earn yield on top of your assets, it's worth doing an additional layer of research into the protocols, their audit track record, their bug bounties, their multi-sig setup. Evaluate if it's a volatile pair, if you're exposed to IL and how severe it's been historically. Based on that, you can attempt to project what it's going to be near term. And finally, if it's a stable swap, evaluate the potential exposure to depegging events, how the pool can imbalance, and how you can essentially get wrecked if you're not taking the right steps. And considering all of these factors, it's worth monitoring them actively, mitigating them, setting an exit strategy if needed, especially if you're an LP, and reevaluate over time if conditions change or like a new protocol infrastructure comes up. Thanks, guys, for joining us. Next time, we'll be talking about optimism. As I was mentioning, we're super excited to be launching layer 2 analytics. And we'll be covering the key metrics of the growth of optimism, how it competes against other L2s, and also the ecosystem plays, the protocols within it, and opportunities that can add value to anyone looking at reviewing the webinar. So thanks, guys. We shared just there in the chat the link to sign up, and I'll be sticking around for a few questions for 5 or 10 minutes.